Good afternoon, everyone, and welcome to Volume 3 of the SAVCA Private Equity Industry Survey releases. We've got a Strategic Insight series, and this is the third installment of that particular series. Volume 3 looks at ESG in particular, transformation and value creation within the sector. Volume 1, we looked at the strategies followed by private equity firms and potential future industry trends. And Volume 2 looked at the actual investment and deal activity within the previous calendar year. I'm Tanya van Lille, I'm CEO of SAVCA and your host for today. And it's wonderful that you could be with us this afternoon to look at three very important topics: ESG, transformation of the sector itself, as well as the value creation in terms of the sector, and in particularly in very turbulent economic times. I'd also like to thank our research partner, EY, that's not only been great at the actual data collection and processing and analysis and creation of the reports, but also brings a lot of subject matter expertise to the table. And we're seeing that today with today's session, a lot more fireside chat, where we've got three individuals that will be the constant, and then EY specialists coming in and out depending on the topic that we're covering. So it's my pleasure to introduce you to your moderator for today, no stranger to the industry, Graham Stoker, private equity capital lead at EY. He's going to be our moderator for today. Graham, thank you so much for being here. I'm going to hand over to you and looking forward to the very robust and interesting conversation.
Thank you so much, Tanya, and great to be on this webcast and moderating for the next hour and a bit. Yeah, really insightful discussions to come. Also lots of insights from the findings from this third part of the SAVCA P study that we'll be sharing. So yeah, stay tuned. Please do share, your thoughts through the chat, as well as any questions to make it an interactive discussion. We've got some great speakers and really want as many of the audience to share their questions and chat, so we can make it as interactive as possible. So to start with, we're looking at the first part, and we're going to divide this afternoon into three parts of approximately half an hour, and looking at ESG and impacting investing. And at the beginning of each session, we're going to share some polling questions. So there are some polling questions that will come up. We'll then share findings, some select findings from the report, as well as findings from the polling questions, which are related to the topics, and then have a 20 to 25 minute discussion with our great array of speakers. I'll let the speakers introduce themselves at the beginning of the panel. We've got two from private equity firms that will be throughout the afternoon, as well as some select speakers on these particular topics from EY. But let's start with the polling questions for the ESG and impact side. So if you can just select your response on the polling questions. We'll give it 30 seconds to a minute. There'll be two polling questions. I'm going to ask Maria from SAVCA to not share the study findings, otherwise it will give away the polling questions. So it'll be interesting to see the thoughts from the audience on these polling questions. We'll share some findings and then get into discussion. And go to the second polling question, Maria. Excellent. Let's see some of the select findings. We'll give away some of the audience from the survey. We've done over 50 PE firms, many funds. So you'll see a strong focus on ESG coming through, COVID really driving that. So audience quite aligned. So yeah, not quite as many as we saw from the PE survey, but interesting to see, and we'll discuss this in more detail, sort of raising the profile of ESG in the PE industry. And then if we look at our second polling answer, and this also looks at some of the polling answer looking at the specific investment mandate, so still not too huge, less than 25% still the bulk of the audience. Let's get into the discussion, and we'll discuss more on the impact investing. Maybe I can start, and Genevieve can come on screen, give a quick intro on herself, then Enver and Paul, and then we can go into the first question.
Thanks, Graham. I'm Genevieve Alberts, an executive at RMB Corvest. Thank you for having me.
Thanks, Genevieve.
Thanks, Graham. I'm Enver Fraser. I'm deal partner at Convergence Partners, based in Johannesburg.
Thanks, Enver.
Hi, everybody. My name is Paul O'Flaherty. I head up EY Parthenon across Africa.
Thanks, Paul. So the first question I had to all of you is, out of our survey, we had, I think, over 58% of PE responding that they strongly agreed with ESG being accelerated as a discussion item, as a focus area for PEs due to COVID. What in your mind are the top two reasons why you see ESG being elevated as a topic in say the last 12 months? And maybe I'll start with ladies first, Genevieve.
Graham, I think for me the fundamental reason is that the pandemic has actually underscored the need to manage risk more effectively. Sustainability is obviously, in all respects, is a key tenet upon which private equity is built. So managing risk has never been more important than through this pandemic.
Great stuff. Enver, from your side at Convergence?
Yeah, I think I want to echo what Genevieve said, and I think what we also found was with the pandemic, there was also a requirement to more clearly measure both the impact that PE is making and then what is happening in the ESG space. So both at the sort of PE level in terms of what we are doing as a PE fund, but also so in essence to our LPs, but then also at the portfolio level, it was important to Genevieve's point around risk management, understanding more clearly what are the risks that sit in those businesses, how do we mitigate it. So the measurement and reporting on that became critical in the last 12 months.
Thanks, Emma. And Paul, maybe a sense from in the market, what you're hearing. I think we've heard a lot more about ESG. It'd be good to get your thoughts.
Yeah, so Graham, we've done a number of surveys, global surveys with CEOs across various industries. And certainly to the colleagues on the call, exactly that coming through. And we mustn't put ESG in such a small bucket. Let's look at sustainability and long-term value. And definitely what we're seeing is companies having to understand their broader stakeholder groups much better, and making sure that they're satisfying the requirements of all the stakeholders. So that narrow view on just shareholders has definitely grown through the pandemic. People realizing they really have to get closer to all stakeholders that they affect.
Great stuff, Paul. Maybe I can come back to Enver and get your thoughts. Where are you seeing in ESG that sort of additional focus? What are, I guess, what's getting more attention in terms of the discussions, and and talking to Paul's point, the sort of broader stakeholder management.
Yeah, Graham, yeah, Paul makes a very good point. So on our side, we've also seen a lot more focused on just the broader impact that both us as PE investors make in the societies we operate in. So making positive contributions, not just looking at the sort of short-term or even our longer-term returns on our assets, but also ensuring that we're responsible investors in the broader stakeholder base. So spending time and effort in looking at sort of enterprise development that supports, of course, the businesses, and to the point around sustainability, ensuring that our businesses aren't sort of islands. I think we had the benefit of operating in the ICT sector, which had a positive sort of tailwind from COVID in most aspects, but that required us also reinvesting in that broader stakeholder, making sure, one, that we are making positive contributions, because we could also have a negative impact. So that was critical to us. And then on the governance side as well, just strengthening the governance and institutionalization of our portfolio companies. So ensuring that the sort of ABAC, AML, and just sort of the board governance of these companies were strengthened, so we could scale these businesses when things turned as well. So if one, address the risks that sit in the business, or make sure we're monitoring those businesses well, but then also once things turn around, that we can scale the businesses with a structured sort of governance in place in those companies. So those were for me the two critical areas that we saw in the last period.
Thanks, Denver. Maybe Genevieve, from your perspective, you've got any portfolio companies in Core West, and where are you seeing, I guess, the greatest focus and attention from an ESG perspective?
I echo Enver's point around governance being a central theme across our portfolio. I guess, given we're a sort of a general fund and we've got broad exposure to various industries, I think other than governance, it's hard to really identify one element of ESG that is more important than others. But perhaps, and obviously the management teams in our underlying companies will prioritize the pillars differently depending on their business realities. But perhaps the one that comes to mind is certainly the negative economic consequences of the pandemic has perhaps highlighted community needs that much more than we've seen in the past. And I think communities have discovered they have a voice and they're using their voice. So I think specifically in some of our our investments in the mining space, in the sort of more infrastructure space, we certainly are engaging far more heavily with communities than we did in the past. And I think it also comes back to Paul's point around stakeholders rather than shareholders. And I think we are far more aware than we ever used to be that we are answerable to stakeholders and not to shareholders.
Yeah, I guess the events in early July shows us the value of a community being behind you. So maybe Paul, if you can touch on any other sort of key topics you're hearing.
I think Enver and Genevieve spot on, but the one big issue we definitely seen through these surveys is climate change and risk that companies are trying to get their minds around. If you look at what the Europeans are doing as they come out of their post-pandemic, as they come through Brexit, the EU is committed over the next 6 to 7 years to raise something like 700 billion euro to invest in the countries of Europe, and 50 to 60% of that's in green investments. So it's taken really, really seriously. And South Africa has made its commitments now for COP26 coming up. It's aggressive targets that we have to achieve. And so I think the entire country and all the companies that work here need to get behind this. And it's not just about reporting on climate change, it's active steps and execution understanding your base scenario and making sure that you commit to what you need to commit to.
Maybe that's a good segue into maybe getting a bit of discussion on, let's call it less of ESG from a compliance and reporting. And I'd like to hear Genevieve and Enver's thoughts from a value creation side, whether it's on maybe decreasing dependency on Eskom, whether it's, other, I guess, often hear P's bringing in the governance to, corporatizing businesses. But, particularly in, let's say, the last 12 months rather than P over the last 5 or 10 years, where are you seeing, ESG being raised potentially more from a value creation side and a value adding side than only a risk management side?
I think, Graham, I think you're quite right. I think the fact that scarce resources are driving up costs forces our clients to think differently about energy and water use and impact on the environment. So our clients that have thought about this proactively are seeing the benefits of implementing green energy and water use solutions on their bottom lines. And in addition, if I think of an example, one of our clients in the engineering consulting space has leveraged their engineering skills to help clients with energy costs by developing solar and water use solutions as a new product offering. I think it's still reactive, to be fair, and it's early days, but it's definitely gaining momentum. I do think that from a regulatory perspective and a reporting and governance perspective, I suspect it'll impact big business first. And that will then obviously, they will then drive their supply chains, and it'll affect the sort of clients that Corvest invests in. And we will over time have to get much more proactive about it. Thanks,
Genevieve. Enver, your thoughts?
Yeah, I echo that as well. So I think on our side, one is we have a mandate from both our investor base as well that we need to shift to sort of greener, sustainable and renewable energy sources. So it's also a priority for us in terms of just meeting our investment mandate. And when we look at the companies we invest in, it's important in terms of, as I say, not just the compliance of it, but over time we've seen that when we are looking to exit some of these businesses, especially in the last sort of 12 months, there is real value that's attached to businesses that are sort of further along the chain around either improving the use of renewable energy sources or just thinking differently about how they improve efficiencies. And then, of course, there's always the business opportunity. So being in the tech space, there's lots of new technology solutions that have come out in the last sort of short period that have driven this accelerated demand for new solutions. So for us, in that way, it's sort of not just in the portfolio, but we see real investment opportunities and growth of this renewable and sustainability on the climate side. That's going to be increasingly important for the types of investments we make and how those investments are then able to grow going forward. So it's becoming it's not just a tick box exercise now, but it's critical for us in terms of our investment philosophy.
Thanks, Enver. Paul, I wanted to get anything else that I guess we're hearing or seeing in the market on ESG from a value add side.
Yeah, I think, Graham, when you take it to the bigger long-term value framework, we've done a lot of work. I think there was a work we did overseas with about asset managers, companies that represented about $35 trillion of investment, and valuing companies, and moving away from just pure price earnings or cash flows is really the name of the game. What is the embedded value in the company? And it's going back to the company defining its purpose. And does its purpose fit in to society? And how do you value trust? and reputation of a company. And you know, ESG talks to that, and commitments that companies make, and relationships with the stakeholders. You know, you mentioned it, you know, the riots of July, those companies that, you know, when we surveyed those companies that remained resilient are those that had the very good stakeholder relationships. Now there's a value attached to that. You know, and all your components of ESG is making sure that you're capitalizing on that value by being a good citizen, by having a purpose, you know, that appeals to people.
Thanks, Paul. Yeah, go for it, Enver.
Graham, I'm just adding as well, I think we also see it in the companies. I mean, we'll speak to some of the, you know, the impact on staff and sort of internal company stakeholders. But I think to Paul's point, this, you know, creating a company that people can associate, you know, with in terms of the values they hold as well, also resonates well, and then improves, as you're saying, the resilience of these companies going forward. So it's also critical in terms of the sustainability of the businesses and the teams and the people within those organizations, that you have a considered approach to sort of ESG that's not just lip service, but that becomes part of the culture.
Maybe I'll extend this topic by, you know, one of the key findings out of our second volume was, I guess, a lack of exits or more exits needed. If we look at the investment that PE have made versus exits, I wanted to get thoughts from all of you on, you know, questions you're hearing from potential buyers, you know, as you prepare for exit or as you go through exit process, and whether, you know, this becomes also a more important discussion topic, and not just from a risk management or compliance, but a long-term value. You know, it's part of the value. And yeah, maybe I'll start with Genevieve and get your thoughts on this, whether it's either been in an exit over the last 18 months or more just how you're thinking right now in considering anything that might come up in the next year or two.
Absolutely, Graham. I think from an exit perspective, obviously as a primary shareholder, you're looking to maximize your exit value, and the very heart of that is sustainability, and sustainability on all fronts has to speak to ESG. So it might not be a specific topic in that form, but certainly how it impacts the business from a sustainable perspective is something that we go through with any potential buyer. And I suspect over time I think that'll come to the fore even more. I think it's probably a theme that'll gain momentum.
Enver, your thoughts?
Yeah, I think from our side, the exits that we've had in sort of the last 18 months, a lot of it's also been driven by compliance. So the fact that there is a strong ESG framework in place and sort of compliance creates real value, because a lot of the regulations, I think both Paul and Genevieve's points was that, you know, regulation is increasing in terms of ensuring there is compliance with a lot of the ESG components, but especially in some of the areas where we have licensed entities, there is real value attached to being compliant, that you don't need to go through or the buyer doesn't have to go through any process of ensuring compliance, because that then either leads to discount to the exit value or some form of premium that can be provided just by having that in place, well structured, well documented, and clearly measured. So that's what we've seen. So it's not so much on it's more on the sort of compliance side of the scale.
Cool. Paul, do you want to add anything? And then I'm just going to close with one last question.
Yeah, I think Graham, I mean, those are very good points. Maybe and it's metals and mining specifically. You know, we've just done this global survey on the 3 top risks facing metals and mining companies as they go down their journeys. Number one risk was environmental and social issues facing them as companies and the acquisitions that they need to make. Number two was decarbonization, and how do they, you know, get the goals in place? How do they become more energy efficient? How do they change their energy sources? And the third highest risk that they believe they're facing is exactly to end this point, and that's license to operate. And so how do you put a value to that? And those companies that can address those are in that particular industry are those companies that will survive.
Thanks, Paul. So I'm going to close with one sort of closing question in terms of, there's a number of audience, we'll just also check if there are any questions, but what is your one or max two sort of key points of advice for, let's call it PE firms, given number the audience is in PE firms like yourselves? What would you your sort of key points of advice for, I guess, at least now and into the next year be from a ESG but a sustainability, long-term value topic? Maybe I'll start with yourself, Genevieve.
I think it's important to stay relevant as a firm within a community amongst those stakeholders that you have, recognizing who your stakeholders are and how to remain relevant. And it just comes back to the point of sustainability. You know, on the one hand, you've got regulation that drives ESG principles, but on the other hand, it is a way to create value, particularly in an environment where resources are becoming scarcer and scarcer, and that's driving up your costs. So having it top of mind, having it as an ongoing agenda at your board meetings ensures that you are constantly thinking about it and sort of trying to stay ahead of it.
Thanks so much, Genevieve. Maybe I'll come to Paul next, and I'll close with yourself, Henry.
Yeah, it caught me off guard there, Graham. So I think we're seeing a few things. You know, I think you've got to move away by seeing the reporting side of ESG or climate change beyond just the compliance. And our recommendations is there's a lot of convergence going on. Be part of that. So all of these accounting bodies, these reporting bodies are coming together to create one set of standards. Be part of that. You know, the second is, to Genevieve's point, adoption. You know, this is something the whole company must embrace. This is not just about, you know, the CEO has to worry about it, or the sustainability officer, or the SHEC officer. The third is assurance, making sure that around your numbers and when you're getting to grips with your stakeholders and their requirements, you know, you can measure it and you can actually, it's something you can talk to and something you can have plans. And the last is using technology as best you can to, you know, facilitate and drive what you need to do from an ESG perspective.
Thanks, Paul. Enver.
So I think it's been more difficult for me now because I think all the answers have been given. So maybe try and add a little bit. So maybe just to add a bit of, to add on to what was said, I think from our side, it's been critical, as you said, Paul, to get the buy-in sort of across the organization, and in that way it's important to link it to KPIs. So it's not just an add-on to any decision, but that it is tied into the KPIs, the same as the financial metrics that we measure for our investment performance, and we then measure our both the performance of us as a fund and in our portfolio companies, but that we add the measurement and the performance and as a key measurement tool, a key measure of the performance of our people as well. So and that's tied into incentivization, so that it's not just as Paul was saying, it's not the CEO or the sustainability officer or compliance responsibility, but that everyone takes ownership, and it takes a long road. So it's taken us quite a long time forward to become ingrained within the organization that ESG is not just some few letters that we add to our sort of brochures, but that it's really part of how we think about the investment process, or from start to finish.
Thanks so much, Enver. I'm going to close it there. I think some great points there on really ESG a lot further beyond compliance, really the whole P organizations, but also the underlying portfolio companies, you know, and again, not just a compliance officer, but really entire management base and employee base embracing it, and then all stakeholders being involved, and then looking at it from a value creation perspective, and not just, but reporting also important to get everyone's buy-in, and the KPIs. It was actually one of the survey questions. So it was a great added point, Enver, when you're under pressure, and so much is great to have a further value add coming third. Thanks so much. We're going to pause the discussion there. Paul's going to leave as our sort of sustainability expert and leader from EY. We're going to go into some polls on our second session on transformation within PE firms, and looking at the transformation within PE teams, and then also broaden the discussion into, you know, how PE is involved in transformation broader. So have a quick look at the polls. While those are up, I'm just going to quickly look at the Q&A to see if there are any questions we need to answer. Yeah, great question there, Rob, on the S, on the social society side. And yeah, I guess definitely see, and I think we talked about the community, and I think it also always understood S as the society, but I guess one could almost replace it with stakeholders, and getting all stakeholders, but society is large. So definitely part, and sorry, I think we did do quite a bit of that discussion, that great question. Yeah, I definitely think in pitching for more LP investment, Louise, ESG coming up more and more, and a wider topic. So happy to get any points I get, particularly from Enver, but I'm not too sure how much Genevieve would engage with stakeholders, more Enver's side, but we can get Enver to close out on that question. So maybe we can, yeah, Enver, you want to add to that? I don't know if you picked up that second question before we get to the answers of the poll in terms of LPs bringing up ESG more as a topic.
Yeah, so Graham, maybe just a quick point. So agree, I think we have seen this throughout sort of our life. So our LPs have all been, or have been, mostly development finance institutions. So it's always been an important point to ensure that we comply with ESG requirements, and these have changed over time. But in our most recent engagements, definitely seen a lot more emphasis on ESG, and then also, as we've discussed earlier, the fact that there needs to be clear measurements. I think the anecdotal, sort of just pure quantitative reporting on ESG is of less value now. It's critical that for us to be able to report back to our LPs on both the quantitative and qualitative aspects of ESG.
Thanks, Enver. Cool. Can we bring up the polling answers first? Let's see. Yeah, so if I look at how many PE firms in South Africa, greater than 30% of females. So I guess 16 to 25%. Yeah, close, but interestingly, you know, the correct answer was actually 44%, where 12% even more than 50. So it was actually only 2 out of the audience, and the 6 was actually up to 44%. So yeah, it was quite insightful and great to see. And we'll get into the discussion, because when we compare it to our global findings, we're actually seeing P's in South Africa and Southern Africa having better female representation, not quite as much in the front office as back office, but better than global trends. If we look down, let me just try and go down to the second one. How many PE firms globally at greater than 30%? And there, you know, I see the answer, I guess everyone was in the sort of 16 to 40% range. Actually, it was right down at A, because it was 13%. So the less than 15%, you got it right, and really showing, you know, globally it was less than 13%, over 30% female representation, but in South Africa and Southern Africa, a lot more. And yeah, please go and get into the results from the study more. We're sharing a bit on screen. But maybe I'll kick off the discussion with Genevieve and Enver, and almost get your thoughts on, you know, why is it that PEs in Southern Africa have done much better, at least on our global surveys, compared to what we're seeing globally from PE. We know it has been improving when we compare to the year before, but I guess has been a lot better to having transformed teams in South Africa. And maybe I'll start with Enver this time, and then I'll come to Genevieve to get your thoughts.
Yeah, Graham, I think from our perspective, I think just there's been quite a strong focus just as a country, I think, and as the region, around diversity and inclusion. So it's not a new phenomenon. So that, I think, has driven the focus and impetus to have more females in the teams. I think there's still a long way to go on that front, especially in the PE industry itself. So I think it's I think that's probably one of the primary reasons. I think we have got the stick and the carrots. I think there's a combination of those that exist that help to drive it. And I think especially in recent times, we've seen a lot more of the stick coming out. So that's helped, I think, to drive a lot of the thinking, and there's been, I think, increased buy-in by PE funds more generally, that there is a need for increased diversity in the teams and the value that it brings. So I think those are sort of very generic points, but yeah.
Thanks, Enver. Genevieve, would welcome your thoughts on anything to add. I think Enver stole quite a few of the obvious points I thought of, but it'd be great to hear any added views from yourself.
I think I agree 100% with Enver. I think we've got the advantage of legislative drivers, triple B, E imperatives, the employment equity scorecard, financial sector scorecard, all those sorts of things. But those have all been in place for several years, and I think this is a case of sort of legislation or the stick driving habit. And I think over time, PE firms have started to reap the benefits of diversity. And I think that then in turn drives a deliberate focus on transformation. I think it's now normal where it wasn't before. And I think that in itself has made a big difference.
I mean, great to hear that sort of, I want to call it, holistic approach and not just legislative or compliance starting to drive diverse teams. Maybe any other, particular, let's call it, strategies or things, your firms are doing to drive a more diverse, not just female, but just a diverse team Because when we think about P value creation, I think it's also about diversifying the value add. So would welcome, your thoughts on the things you're doing to drive a more diverse team. Maybe I'll start with Genevieve this time.
Thanks, Graham. So I think what we have realized, maybe there's two principles here. I think that the first one is it's easy enough to recruit diverse talent. It's a whole lot harder to keep it, for many reasons. That's the one thing. And the other thing is that transformation, at the risk of sounding trite, is a journey. It's not a destination. So as long as we always realize we can do better, I think it always drives the right agenda. So I think what we're trying to do around, and I think what all of us need to be doing around retention of diverse talent, is think about the sort of the barriers to making people feel part of a team and part of an environment and valued. So I think it's about being deliberate about inclusivity in an office environment. It's about creating a culture that is conducive to people feeling like they can bring their true selves to work and not be part of a boys' club necessarily. And I think that the third thing around recruitment is I think it's also recognizing that deal makers are not robots. I think we need to move away from the sort of one size fits all mentality around recruitment. A good deal maker is not automatically a white male chartered accountant, for example. I think it's about embracing diverse educational backgrounds and focusing rather on the attributes that make a good deal maker and solve for that. So obviously financial acumen is very important, but it's only one piece of the puzzle. And one can argue that women, for example, are better at some of these aspects and factors than men, and vice versa. It's about really looking at all the things that make a good deal maker and solving for that. And hopefully the diversity will come.
Thanks, Genevieve. Enver.
Yeah. I think just to add 2 points to that. I think the one is on the active recruiting. So I think there has to be to Genevieve's point around really that in terms of just scoping the job, that the job spec is also important in terms of how you recruit people to make it something that is appealing to a diverse potential workforce. And then in terms of the retention within the organization, I think there is a need to be more considered around career pathing and to the points that Genevieve made around just that it's not a one size fits all, that you have different qualities that are required to get output, and there's recognition of that within the organization. So it is a culture change to say we're not just measuring it pure on sort of financial acumen or financial metrics, but there's other aspects to a PE professional that needs to be built out and supported and grown. And then from our side, I think we've also had a real considered approach around trying to sort of grow our own as well, looking at how we recruit young graduates into the program, and especially focusing on female graduates, giving them exposure at a younger stage. So it may not be, they may not stay with us throughout their career, but at least they get a sense of what is required and hopefully help equip them for entering into the broader PE career in future.
Thanks, Emma. I think great points there, which must feel linked back to one of the points Genevieve raised on retention, is also about expanding the pool that you source from, which speaks to that graduate program and getting, a bigger net of potential deal makers. We're talking deal makers because I guess it's the front office of PE where we saw the less diverse. Interestingly, the back office we saw from a Southern Africa perspective, actually over 50% being female, 55%. out of the more than 50 PE firm survey, which is great. But I think finding both, the strategies, retention, and everything to get the front office more diverse and different bits of value add to that investing space, but also value creation and exits. So deal making is one part of the front office, but increasingly, value creation is key, sitting on all the boards, which I definitely see as part of the front office. Would welcome your thoughts, Genevieve, on how this thought process then extends into the management teams you work with, and you yourselves as Corvest or others setting the example of a sort of transformed team, and how that helps in maybe diversifying the management teams that you back and support at the portfolio companies.
Difficult question to answer because, obviously the Corvest strategy around management teams is very much to back a management team and over a period of time, drive some of the other agendas that we've been talking about. Starting from a board perspective, I think that's perhaps a relatively easy way to sort of at least start driving transformation. And then hopefully that filters down to management teams as well. But I think in terms of finding female, or just the sort of more broader concept of diverse talent to populate boards with is again coming back to Enver's principle about being deliberate, and an active recruitment strategy to find suitable board members. I think the other principle, and maybe helps one appreciate that how important it is that if you genuinely embrace diverse thinking, knowing it will drive a more holistic and perhaps a better solution, then it's easy. So I think if you appreciate the value that comes with a diverse board, that's, I think, half the battle won. And then it's obviously up to the board to drive all of the pillars of transformation within the underlying companies.
Great points. Enver, welcome your thoughts on any other things you're doing from a convergence perspective, and maybe, I guess it is hard on just the direct management team, but I guess often P is also about developing that succession plan, because so often you've got that senior management team that you're backing, but often in the entrepreneurial businesses, it's maybe not quite as clear, but like developing the corporatization, the next tier of management. So welcome your thoughts on diversifying the management team or the key employee base at your portfolio companies.
Yeah, Graham, I agree 100% with Genevieve. I think it is often difficult to have a wholesale change or to even the timing around it. It takes a lot of time and effort, again, because it needs to be buy-in by the management team. I think it is sometimes easier if there are clear gaps in the management teams that are in the companies. So you can then, in filling those gaps, saying, look, this is the approach. But it is, you also don't want to upset the dynamic of the management team or the dynamics within the management team, which you of course brought into back. But what we have attempted to do as well is in the companies that are more sort of have the scale to be able to do it, look at setting out the policies in place, firstly around diversity and inclusion. So as sort of the stick side, but then the carrot side being to show to the management teams what value comes in. And as you said, Graham, in succession, it's a clear objective for us that from the driven from the board, as Genevieve said, that there has to be transformation in terms of that succession plan for the team. And I think, it does take time, like all of these things do. So there is then a sense from the management teams over time they can see value being created by having these different voices and just different skill sets that they sort of didn't see as having potential to add value to the business. So for us, it's an important sort of imperative, and we required of the business. So when we go in, one is there is the BEE or triple B, BEE broad-based Black economic empowerment requirements that a lot of companies need to fulfill, which we then can roll into this broader, building out a more inclusive and diverse workforce. But it is something that takes a lot of time and effort. So it's not something that we've always had complete success with, but we have seen the value of it through building out strong second tier and then finally succession planning to businesses over time.
Thanks, Em. And maybe that's a good point on PE being part of a bigger transformation of businesses in South Africa. And I know RMB Corvest and RMB as a whole has been part of transforming and have, I guess, leaders in some Black-owned PE firms. Genevieve, would welcome your thoughts on PE as a catalyst to transforming or just leading transformation in business in South Africa.
Thanks, Graham. Yeah, I think PE has played a very valuable role in terms of transformation, particularly around backing BE transactions at the ownership level. It definitely is easier to transform an underlying business when you have a major Black shareholder on your board helping you to drive that agenda. It definitely speeds the process up. So I think if you think back to sort of the early 2000s when Black economic empowerment deals started becoming more commonplace, that's when PE really started to play a pivotal role. I think the early deals were largely vendor funded, but a lot of those structures were unsustainable and didn't really create value for shareholders and beneficiaries. And I think at around that time, private equity entered the fray and funded a lot of the subsequent deals that happened, most of which I think have created real sustained value for Black-owned investment companies and the underlying target companies as well. I think the money created has stayed in the market. The underlying target companies have, for the most part, benefited hugely from having a more representative shareholding base. And those deals have served as a trigger to address the other elements, as I said. Even now, I think most of the PE firms in the South African market are still entertaining a sort of steady stream of young Black entrepreneurs looking for funding for their deal flow. And hopefully we continue to play a role in creating a new generation of Black investors.
Excellent. Enver, you want to add to that? And then I'm going to close with one last question.
Yeah, I think just another aspect from our side is just, as you say, bringing the funding in. I think you can add the conditionality to businesses which helps to drive that transformation as well. So whether it's social transformation, focusing on enterprise and small sort of SMME development, and then the sort of almost value chain. How do you drive the growth of Black businesses as part of the value chain within the businesses you invest in, and then ensuring that those businesses have clear transformation targets that are tied to the money that we're putting into those businesses. And then, of course, that's driven both by incentivization of management and then the shareholders, the sort of founder shareholders that we partner with, ensuring that they understand that in order to access the funding they have to go on this path of transforming their businesses and the broader stakeholders. So I think just as an addition to the points Genevieve.
Cool. I'm going to close with coming back to the talent strategy within PEs and would welcome your sort of top 2 or 3 things in terms of how your talent strategies have potentially evolved, I guess particularly over the last maybe 18 months to 2 years, and I guess talking to, again, not a diversity from just a stick approach, but really, I think Genevieve hit the nail on the head once you really think about a wider discussion and how different skill sets and experiences can add value. But yeah, I want to hear your sort of thoughts or advice to the PE participants listening in on how, in your view, the private equity sector could, focus on talent, and your sort of thoughts on talent strategy. Maybe I'll start with Genevieve.
I think most of the points have come out. I think maybe just in summary, I think it's important to note that diversity is not just a function of demographics, but also of leveling the playing field through access to internal opportunities, such as access to deal flow, mentorship, and support. And I think, Enver touched on some of these things a little bit earlier. And I think the other thing is, obviously, as I said before, recruit based on the attributes you need for the role, rather than profile, background, what school you went to, that sort of thing. And again, create an environment that supports inclusivity and diversity. It is easier said than done, and you can't do it based on your own assumptions of what that means. I think you need to consult your team, particularly, the younger, newer members of your team, to understand what that really means in practice.
Thanks, Genevieve.
Graham, I think for me, the 2 points, and Genevieve covered the one which was around the environmental factors. I think those are critical to talent, and both retention and recruitment. And I think tied to that is, I think what we've experienced now with COVID is just a shift to being more flexible. So the remote working, work from home type things has changed both the way we appreciate what people are doing, or understand what people are doing. Because I think previously everyone had, it was more driven by physically seeing and engaging with people. Now there's a different approach which has its benefits and its disadvantages. And then the other critical factor is also then around reward, to ensure that the sort of reward process and component of how you manage your staff, whether it's performance, is shaped around the points Genevieve made around, that there's value in diversity and creating this inclusive environment. So the reward system also needs to be reshaped to accommodate that in the process. And I think those, for me, are critical elements to both the recruitment and retention of professionals in the PE space.
Thanks, Enver. I think some great points of advice to everyone. I think some key insights and thoughts and key points on, not just recruitment, but retention and the value of really incorporating and the inclusiveness, and how you approach inclusiveness, particularly in a virtual environment that we've been in, and probably most PE firms have not had that sort of as much face-to-face contact as before. So how you tackle that inclusiveness is probably also critical at retention and developing the talent pool that can lead to better diversity right up to the board level, which maybe we haven't done as best, and it all starts through a process right up to, because it will take time to develop more and more of that diverse pool. I'm going to leave that discussion there. I'm quickly looking at the chat and questions. We're going to transition to value creation. I'm going to ask Azim, one of our guest speaker who leads our EY private business, but to kick off the session on value creation, we're going to share some polls again, look at some of the key findings from our survey results, and then get into a discussion on PE and the value creation PE is doing. So the first polling question you can read and contribute, really looking at the number of employees. And when we did the study, we stripped out any of the new portfolio companies as well as disposals, and it's very insightful to see the answers, but would be keen to see what the audience's view is of how employee numbers may have decreased or increased from December 19 to December 20. And then the second question is on revenues and similar. What is the audience's views of the PE-backed companies? We ended up having just under 100, almost 100 PE-backed portfolio companies that we had data on. And yeah, we can then compare what we picked up in the survey with the audience's thing. So let's leave it there for, okay, and let's go to some of the findings. So you'll see some of this come up on screen. Yeah, actually, our audience got it right this time. 46% or believed there was an increase of employees. That is right. We actually saw a 4.2% increase in employee numbers, despite the challenges of COVID. So on the first one, we got it spot on this time. And I thought a really positive illustration of the PE-backed companies really growing. And then from a revenue perspective, interesting to see. I don't know, someone must have given the clues, because I didn't expect the audience to do as well as this. So it was very insightful. Revenue was growing on average 8 points. I think it was 8 points. Let me just check my notes. 9.7%. So yes, over 6% was the increase. Very surprisingly, when we compare the 2018 to 2019 growth, that 9.7 was below 6%. So surprisingly, PE-backed companies were growing stronger in 2020 than 2018 to 19. And then from an EBITDA perspective, also stronger growth, and that revenue growth flowing through. And actually, even though COVID may have led to some cost savings, the EBITDA average margins were actually, very similar, actually just 0.1 percentage point down from 2019 and another 0.2 down from 2018. So really revenue growth, and not, the typical PE cost saving and cost cutting driving value creation, which was, really good to see and insightful to see. So yeah, maybe I'll start with Azim. If you can do a quick introduction, great to have you on board, and then we can get into the discussion. I'll let you do a quick intro on yourself.
Thank you very much. Good afternoon, Graham. Good afternoon, everybody. Name is Azim Omar, and I head up EY Private across Africa, which effectively means I look after all privately owned businesses, including PE-backed ones. So very glad to be here. Thank you, Graham.
Thanks, Azim. So I'm going to start, Genevieve and Enda. I was surprised by these positive results on both employee growth. I think how does it compare to your experiences? Not to give away the whole thing, but maybe just your perspective on how these results compare to what you may have thought and experienced in your PE firms. Maybe I'll start with Genevieve. Sorry, not with your PE firm, but with your portfolio companies.
So the core-based experience is very consistent with these findings. One of our colleagues, as part of his MBA thesis, has actually done an analysis of job creation within the core-based portfolio over the last 10 years. And on a sort of a compound annual growth rate basis over those 10 years, the findings are very consistent with your survey. And I think that sort of, if in the context of the fact that the South African economy as a whole is actually shedding jobs, I think is firstly something to be proud of, but I think it also underscores the point that private equity is not what people think it is. There's this global idea that private equity is this barbarians at the gate concept where PE firms do asset stripping, cut costs where they can, share jobs for short-term profit. I think this tells you, these findings tell you a very different story. I think that certainly in South Africa, most PE firms are absolutely focused on growth. And hopefully with that comes job creation.
Yeah, great points. Enver, well, be good to hear your thoughts.
Yeah, I concur with Genevieve. So I think again, the same, I think our philosophy is also one of growth investing. So it's sort of the natural impact of that is that in most cases there are new jobs created. We're also trying to create more sustainable businesses and ramping up these businesses to be, not to remain in terms of size, whether it's profitability or just the sort of products and service they're offering. So by default they will or should increase. I think there is some anomalies in our space, just because in some cases, just in the technology space, that growth doesn't always tie into job creation. So I think in our experience, there's sort of ups, sort of overs and unders, in the sense of some businesses have grown in terms of employment, others have either remained static or in some cases may have shed some jobs, just because the nature of the businesses and the efficiencies that can be achieved through the nature of sort of technology means that there isn't the same sort of job growth in the investment in terms of the value of investment we make. So overall, there is the positive, but there is also some sense of in some cases we have seen not significant job losses, but probably not the same job growth that should be associated with the growth of the businesses over time.
Thanks, Enver. And it's aligned with also our findings, interestingly, which I hadn't mentioned. We looked at the number of the 97 companies that we had all the data, which was Ps that shared the entire sort of one-by-one company information at the high level. And the ratio is similar, but it was slightly less in terms of the number of employees growth, but obviously showed that where there was growth achieved, it was outweighing the sort of ones where there was a downward movement in employees. Nazim, I'd like to get your thoughts on two things, what we're seeing in the market, but also, how does your thoughts on, I guess, why we're seeing this from, I guess, the private business space, from, we all see the overall GDP and the challenges in the overall economy.
Graham, it's really interesting hearing also from Genevieve and Enver, because what we've been seeing in the private space is exactly that. We've actually seen a lot more growth over the last 2 years. Initially towards the earlier part of 2019, it sort of slumped off a little bit, people getting worried about COVID, etc. And in 2020, it just sort of shot the overall lights out. So we've actually seen that the private companies or the PE-backed companies ended up gaining ground a lot faster, or as we all say, bouncing back a lot faster than what some of the corporates did. And you asked why, so we've been actually looking into that with a number of our clients. And one of the biggest reasons that we've picked up is that many of these businesses actually manage to be, or many of them are owner-managed businesses, right? Whether they're PE-backed or not, they're owner-managed. And what that means is, any ideas or any new ways of doing things, they're very quick to be able to pivot and sort of activate it. If I may give an example of that, is that in the start of COVID, we all know the hospitality industry was hit really, really, really bad. And a company like Capital Hotels, owner managed, they run the actual business, the owners in it, yes, they are PE backed as well. But they said, look, we're not going to have, if you all will, can remember, we're going to lockdown for 3 weeks. And we said, okay, you know what, 3 weeks and we'll be back. I think it's 1.5 years and we're still not back. But they, after the first month, they realized it's going to be a lot longer term. And they quickly pivoted their overall business from being a hospitality place to suddenly being a quarantine place. So whether you were traveling in, whether you were traveling out, whether somebody in the family was actually sick, they turned their hotel group very quickly into a place of safety. They got doctors involved, etc. So that shows how quick the private businesses are actually able to move and change what they're currently doing to something else. And if I may give another example, and this is the one everybody would have heard of, right? I've got a friend, he runs a sauce company, so all your tomato sauces and barbecue sauces, etc. COVID obviously hit 2019, and suddenly hospitality went belly up. No restaurants, nobody to actually supply to. So what this individual did is he went and looked at his factory, cut out 1/3 of it, and suddenly started doing sanitizer. You all may know what that is now. Many of us never used hand sanitizer before that, but it's pivoted his business to a totally different level. And both of these companies, I can tell you, in the last 18 months to 2 years, they've actually increased their GDP, their earnings per share. They've overall increased the number of staffing that actually work for them. So overall, Graham, I think it comes down to owner management being able to make decisions a lot faster, as well as having that entrepreneurial mindset.
Okay, some great stories there. I've often heard PEs talk about management, and the team. I welcome sort of Genevieve's and Enver's thoughts thinking about those stories from Azim. And, even in the last year, particularly in the sort of 4, 5, 6 months into the thing, and often hearing about PE teams, telling me about, they're just so impressed about some of the management teams and really adapting. Would welcome your thoughts on those sort of comments shared by Zim and what you've experienced with your portfolio management teams, whether they've, adapted very quickly and well, and that's been helpful in sort of continuing the value creation drive and not sort of stumbling.
Shall I start, Graham?
Yes, sure. Thanks, Genevieve.
Yeah, I think I echo Azim's points around owner-managed businesses being typically more agile. But I think where they are private equity owned, I think it's also up to the private equity firm to create an environment that's conducive to, or gives them the flexibility to be agile and rewards that agility. And I think because we partner management teams, and it's typically a private equity model, there's an automatic alignment between PE firms and the management team. So creating value means the same thing. And I think that alignment plays an important role. I think another element of it all is PE firms typically focus on revenue growth. Yes, you try and reduce costs, but you can only do that once or twice. It's not a sustainable strategy. You can't save yourself rich. But by focusing on revenue growth, it has a knock-on value creation effect for all your stakeholders. So not just shareholders, but staff, receiver revenue, supply chain, customers, and that then obviously supports positive market sentiment. So I think there's definitely a broader theme around value creation and focusing on revenue as a relative focus.
Thanks, Genevieve. Enver, I would welcome your thoughts too.
Yeah, so I think the one additional point I want to make, I think what also helps in being sort of PE back, also that to a lot of the management teams, we often bring experiences from across our portfolio, and that's often very valuable. So I think it helps to just the thinking process and the ability for management teams to pivot with input. So to Genevieve's point around, the alignment with management. So I think there's a a useful sharing of information and experience across our portfolio that is critical, and even just allowing management teams to speak to each other, which we also found very valuable in helping people come to terms with it. This was sort of unprecedented in terms of what it meant for the management teams, and we found that very valuable in just changing some of the thinking that teams could be, the management teams could be more innovative in how they thought about it, and then in some senses also being more accommodating as BFund. So being able to offer management teams the ability to say, we're not sort of turning off the taps now, and you have to paddle your own canoe in getting through this, but providing that support, both financial and other support to the management teams, because it's also quite a daunting process for people to expecting 3 weeks and ending up 18 months later. So that just sort of psychological support and was also, I think, quite important. We saw coming out of the period. Cool.
I want to discuss a bit more the sort of levers of value creation and particularly on the revenue side, because we definitely are seeing that that revenue growth I mentioned across the portfolio was higher than EBITDA and employment growth, and really P is driving top line. But your sense, and I'll go through all of you, what are some of the things? I think you talked about, Enver, the sort of engagement and sort of the softer side of sort of engaging with the management as a shareholder and management, I guess, team together. But any other thoughts on those levers and potentially how those may have changed over the last 18 months because of COVID and looking at value creation? The world, I think COVID has accelerated the digital transformation. But yeah, just would be good to get some thoughts on any other sort of one or two things from your perspectives. Obviously, it differs business by business, but maybe there's one or two more common themes. And Genevieve, I'll start with you in terms of what you're seeing as sort of the drivers or levers of value creation and driving top line growth.
Management. Jokes aside, I think what we definitely saw during the pandemic is that the strong management teams really came to the fore and were able to sort of take advantage of the opportunities created by the pandemic. I think it comes back to the sort of the principle about privately owned businesses perhaps having more flexibility, and I think that's really important. We try very hard not to instill the sort of stifling and rigid governance that is seen in perhaps the listed space and perhaps in big corporates. And that, I think, gives management more scope to act, more flexibility, and hopefully we don't get too involved in that, but rather support it with strategic direction, with ideas, with cross-pollination within our existing portfolio, bringing management teams together and bringing businesses together. And at the same time, just trying to ensure that you are managing a tight balance sheet along the way. And that definitely has played a role. I think for the most part, if I look at our portfolio, the portfolio has weathered the pandemic pretty well. I think generally private equity firms have had an active strategy to try and invest in more defensive industries, and I think that definitely plays a role. I think we've tried to manage management talent quite carefully. And again, coming back to alignment, I think alignment is key.
Great points. Azim, any other thoughts from, I guess, what you're hearing from entrepreneurs and speaking in the market?
Yeah, Graham, thanks. I do agree with what Genevieve said around management, but I like to tweak it slightly in the sense of leadership. What we've actually found is you get some great managers out there, but a leader is somebody who sometimes takes a bit more of an additional risk. Will try and go a little bit more, but most importantly, making decisions really quickly. And, yes, knowledge is key, understanding what's happening in the overall market. And many of us, we all have heard about black swan, etc. And initially COVID was a black swan, and now they say it's going to happen all the time. And it's about understanding where your business is going to be, in the next 6 months, 12 months. What are the big disruptors and how quickly can you pivot it out of there? So, I mean, as we've been working with some of these private businesses, we came up with a model about now, next, and beyond within EY. And it's, what do you need to do immediately? What's the next sort of level that you need to attack it? And then what happens beyond that? And what we find is that leaders who think in that sort of direction make a big difference in their company's long term. And a final point, if I may, Graham, is that we're also finding innovation is a big thing now. It's no longer just management or leadership that have to do innovation. It's throughout the entire business, and rewarding innovation in the sense of whether it's giving the person to run with a particular project or whether it is a financial reward or whatever it may be. We're finding that seems to be key for a lot of these privately owned businesses. It's about driving innovation in the entire company, not just driving it from leadership. So that's some of the things we've been seeing.
Thanks, Azim. Some further great nuggets there. Enver, any points from your side to add to?
No, nothing to add. I think just maybe to emphasize, because I think it's all been covered in the discussion. I think what we found is, as we're saying, both around the leadership and the management, but also just in the selection of the companies. I think that has also helped through this process, that in terms of the companies we have invested in, I think PE has the benefit of being able to sort of filter out what are the sectors, the businesses that should be better performing, and then to ensure that they sort of drive or lever that advantage over, or leverage that advantage over the life of the investment. And then I think what we've seen in our case is just that there has been, of course, just the macro benefits of this digital transformation, the sort of remote working, and the fact that it's driven more consumption of bandwidth of digital services, and we were fortunately placed in the right space. So a lot of the businesses got that benefit, but they also needed to retool how they address the markets. Again, that leadership and management to be able to say, we're not just riding out this wave as long as it can, but how do we retool our businesses to be able to sort of accelerate from that going forward. So that's the additional points. Thanks, Graham.
Thanks, Enver. I'm going to look at some sort of closing points on your advice to those in the audience in terms of, where do you see the levers of value creation going forward? I guess the world seems to just feel like it's changing faster all the time, but maybe COVID has accelerated, and hopefully it won't go as fast as the last 18 months, the acceleration, but it is changing rapidly all the time. So would be welcome your thoughts on so where would you advise PE firms to be focusing for the next year to 2 years in terms of the key areas of focus to drive value creation? Maybe I'll start in reverse order. I'll start with yourself, Enver.
Yeah, I was hoping I'd be last, but
you're putting in a hard place being last to add value. Now you're first.
I could just say ditto. I could just agree with everything everyone else has said before, so I have to think of something. So I think for us, I think it is the big focus has to be on flexibility and not being set on on specific outcomes that you have in mind. So whether it's both as the shareholder in the business and as the management team. So I think it's important that there's a need to have that ability to be able to have more flexibility in terms of thinking, in terms of your actions as a company. And then to the first point we spoke about, just around the sustainability, ensuring that you both build diversity and the right governance structures within the businesses to set up businesses for growth. and that sort of foundation will then help those businesses, hopefully, and PE firms in the future accelerate, both in terms of identifying new opportunities, but also scaling up the businesses that we invested in.
Thanks, Enver. I like those thoughts. That almost brings us back to the start of the conversation on some of the foundations with long-term value, governance, all of those aspects. Go to Genevieve next. Your thoughts on where you see the focus in the next year to 2 years.
Graham, I actually don't see the focus necessarily changing. I think maybe fine-tuning what we're currently doing. I think we've all learned a lot out of the pandemic. I think we've discovered a lot about just how resilient our client base is. But I think it's maybe a closing remark from my side is that private equity plays such an important role around sustainability and longevity of companies. You know, we focus heavily on succession within businesses. So a business that might have started out with a founder or a family-owned business, through private equity, is sustained into the future, often long after the founding families have moved on, and that preserves jobs, grows jobs, retains brands that otherwise would be lost, and creates long-term value. And I think if we remind ourselves of that principle, I think we can continue focusing on growth and remembering that the money we invest needs to be patient if we're going to get growth.
Yeah, great points. And I think it's points that, point to better exits. I think it's all very well having value creation during ownership, but if you focus on value in the long term, you're going to have better exits and better value attributable to that company, because it's, the next shareholder really valuing what you put in place for the longer term growth. Maybe in closing, Azim, your thoughts, I guess, what we're hearing in terms of any changes on the areas of value creation in private businesses. We've definitely heard the leadership, the innovation side, but yeah.
So, Graham, I think one of the big things that many investors have been looking into as well is the adaptability of the various companies. It's no longer one size fits everybody. So it's how adaptable are these companies for the future is the one. But I think a wave that we really need to be conscious of, especially over the next, I'd say, 12 to 18 months, is this wave of burnout. Because what we've also been finding is so many companies who've been running so hard and so fast are sometimes forgetting to just expand a little bit more, or sometimes take a bit of a pause. And we're finding both locally and globally that seems to be a trend of suddenly people are falling off a cliff, for lack of a better term. So it's something just to be a bit more cautious of and make certain that we start allowing people to get back to a bit more of the norm. Genevieve and Enver both touched on it a bit earlier around, pulling out a lot more value, right? Which is fine, but at what cost? So the big thing now is about managing the longer term with all of these companies and the overall growth. And from a private equity perspective, I think it's ensuring that the leadership gets access to all the relevant tools and info. Both my co-speakers actually spoke about how private equity funds actually help the investee companies with bringing them knowledge, bringing them insights. And I think it's these insights and knowledge, a lot of the corporates have definitely got up front, but we need to now distribute it down to the private companies and make certain they are implementing it upfront, as opposed to just doing the same old, because we are seeing this wave may end up crashing, and if we don't address it sooner rather than later. So that's just one piece that I've heard a lot in the market about.
Thanks, Azim. Great point. Maybe should have had you on the talent part of the discussion as well, to make sure we all looking after our teams around us, both in the PE firms, but to have that management. So great insights, great discussions. Really thank all three of you and the speakers earlier to really sharing fairly openly as well, and hopefully some great insights for the audience. I'm going to leave it there and let Tanya do some quick closing. Thank you for also the audience and the questions and comments raised.
Thank you, Graham, and thank you everyone for your contribution. Really appreciate it. We posted the link to the actual volume that you can download in the chat function, so feel free to download it there and go through it in your own time. Interesting, I had a discussion with a lot of other industry associations about ESG, and it seems like South Africa is a lot more mature and robust in our thinking about ESG, so it fits in with what we've seen in the survey. From a transformation perspective, agree there's a bigger role that the industry can play in transformation of businesses in South Africa. And with that context in mind, we are hosting a session with the BMF next week to talk about the value that BE brings to the economy. And then lastly, I think all of the PE professionals can attest to the different roles and hats that you had to wear specifically during the COVID period and the early days of COVID. Not just the technical skills that you had to bring to your portfolio companies in terms of capital structuring and scenario planning and modeling, but also those softer skills needed, the negotiation skills, the being someone that they can lean on and you know, just really being the support there for the portfolio companies. Great session today. Thank you for joining us. We appreciate your questions and comments. And we'd like to invite you to join us for one of our next sessions coming up. And then most importantly, there's limited tickets available for the SAVCA VC conference coming up on the 15th of November. Have a good evening, everyone, and please stay safe.